Okay, without further ado, ladies and gentlemen, up next we have Mr. Geoff Howie, market strategist from Singapore Exchange, to talk about recent Singapore market highlights and themes for 2018. Mr. Geoff is the Singapore Exchange market strategist with 20 years of experience in financial markets and economics. Mr. Geoff previously held lead booking and market strategist role across the Asia Pacific office of a large international futures broker. He complemented his broking profile with the provision of frequent market reports, seminars and commentary to local and international media. He has also served as the Treasury Adviser to the leader of the Queensland Liberal Party in Queensland Parliament. Mr. Geoff also served on the management committees of the Australian Alumni Singapore, which is known as AIS, and is also on the editorial board of HealthInvestor Asia. So here, please give a round of applause to welcome Mr. Geoff. Mr. Geoff, over to you.
Good morning. Ladies and gentlemen, it's great to be here, and thank you very much, Kananga, for the warm invite. And we really are looking forward to spending the next 40 minutes or so complementing what many of the preceding speakers have been talking, particularly Mr. Chan just before, and before that Derek Khan. There's quite a few, I guess, key threads of what they were mentioning, and that will be resonated through our presentation as well. Let's move straight into it. There's a disclaimer here, and it's first and foremost, and it's very important because I come from Singapore Exchange, and being in Kuala Lumpur, everything we're about to discuss is very much an educational presentation. We're basically looking at the same themes that have been talked about today. It's just from a different lens. It's from the lens from the highly international market in Singapore, the highly international stock market in Singapore. In that preceding presentation, there was a ratio of market capitalisation to GDP was 0.95%. In Singapore, we've got one of the highest ratios in the world. It's around 3.0 in terms of where we're at, and that means, and it's a sign that a lot of our stocks listed in Singapore are highly international. They're either generating international revenue, particularly across the Asia Pacific region with the exclusion of Singapore, or they're basing their assets across the region. So everything that we discuss, of course, will be, it's not so much advice or stock picking and so forth like the previous presentations. We're just going to take a quick run through what the recent highlights and developments have been in our marketplace to share with you. First and foremost is, of course, global growth, and that's been very strong across the world. The most recent statistic for the new synchronized global growth was China's GDP for 2017. It was the first annual upturn to GDP in 8 years. That's had a very big effect on Singapore's GDP, as has, of course, the American economy, which has generated higher GDP than expected, as well as having unemployment at a 17-year low, lots of business optimism, lots of consumer confidence. That has generated a 3.5% year-on-year growth in Singapore. I know it's not as high as 5.5%, but nonetheless, it's pretty high for an advanced economy that doesn't have the developing economy growth tangent that much of emerging Asia and, of course, Malaysia has. What's been driving the growth has been our industrial production, particularly in manufacturing and our export-orientated industries. Now, it started predominantly in 2017 in the consumer electronics. It was predominantly semiconductors and precision engineering modules. And then, of course, your medtechs have been an important part as well. And we've seen that as well into our market in terms of new listings. And then petrochemicals, but also what we started to see towards the end of last year was more broader-based growth in terms of the manufacturing industries. It wasn't so much all the high-end consumer electronics, we also saw growth in the aerospace and the food and beverage manufacturing and processes, which is very important because our key opportunity or challenge, if you like, for 2018 is to transpose the cyclical-led growth into broader-based growth, not just in Singapore, but across the world. That's why the US economy, as you know, has performed fairly well. We had the 5 interest rate hikes up to now, another 3 are expected next year, and massive fiscal reform. Tax cuts that will add $1.5 trillion in fiscal deficit over the next 10 years for the United States, because we have to get broader-based sustained growth across the world to keep fueling the sustained growth that we've seen in 2017. In Singapore, as we said, a lot of the focus has been on the manufacturing industries. Our PMI has been particularly strong. When you look at the Purchasing Manufacturing Index, it has been above the key 50 threshold for the last 16 months. So we've had consecutive expansion in the manufacturing industries. In the electronics industry, the next important gauge, it's been 17 months of consecutive expansion. Again, this is our basic desert island indicator in Singapore and gives a good gauge of the manufacturing economy. We might not have as many manufacturing activities as investors might think these days, but logistics, distribution, processing, sourcing has become a very important part of the manufacturing value chain, and that logistics part of the manufacturing business has become very important, not just for Singapore, but I know it's very important for Malaysia, being one of the 5 key points of the 11th Economic Plan that's currently in the process. So logistics has become very important, and I'll show you towards the end of the presentation how logistics has become very important with the One Belt, One Road initiative in China as well. So on the manufacturing front, things have been fairly strong. On the next cyclical front, we've got the total value of exports and imports growing very strong as well. We have a lot more value in exports and imports going through Singapore than we do GDP. In fact, in recent years, it's been the ratio of total value of exports, value-added exports, has been as much as 3 times our GDP. And as you can see, it's had a very strong growth in recent quarters. We've gone from $114 billion in total trade value in the March 2016 quarter all the way to $144 billion in the September 2017 quarter. Key takeaways is that our trade value for the first 3 quarters of 2017 was up 12% year on year, and our bilateral trade with China was up almost 20% for the first 3 quarters of last year. There are other cyclical factors that have been driving the economic optimism in Singapore as well. Real estate is a very core, important part of our economy, as you would know, and we actually had 15 consecutive quarters of decline for our property prices, for residential property prices, as measured by our Urban Redevelopment Authority gauge, which is released every quarter. However, in the September 2017 quarter, we had a 0.7% uptick, which was sustained again for the December quarter, with the flash estimate also coming in at 0.7%. This comes after a little bit of a relaxation of the cooling measures in the real estate market in Singapore, basically through measures such as buyer stamp duty, seller stamp duty, and total service ratio, total loan service ratios, and also supporting that cyclical upturn that we saw in real estate. We also had some cyclical upturn in our tourism business, because tourism is a very important part to our economy as well. Consider we have 6 million people, but 16 million visitors every year. Last year was a record at 16 million visitors. That generated 25 billion Singapore dollars in tourism receipts. So far in the year to date, our tourism arrivals are up 5% from that record-breaking 2007, from that record-breaking 2016. So for the numbers we've already got for 2017, we're up around 5%. So what do we offer in terms of a stock market, and how do all these economic cyclical factors transpose and move our stock market? How relevant is it? How investable is it? We have our Straits Times Index, which is like the KLCI, it's made up of 30 stocks. It's very diversified 30 stocks in Singapore. This STI makes around 50% of our total market capitalisation of all stocks listed in Singapore. And these are companies that have foundations that span as many as 3 centuries, with the Jardine Matheson Holdings, Jardine Strategic Holdings, Hong Kong Land having their foundations dating back to the 19th century, to Hutchison Port Holding Trust, the container port terminal in Hong Kong and Shenzhen, being founded in the 2010s. So these are 30 companies spanning a long period of time, and they also span a lot of different sectors. We have mostly cyclical sectors in the STI though, and because we had an economic cyclical upturn last year, particularly in that export-orientated space, our return of the STI last year was 18% by price, with dividends boosting that total return to 22%. So that 18% price return was pretty much twice the long-term average annualised gain of the STI, which is around 9%. And that compared to around 7 to 8% for the majors of the big advanced financial centres across the world. Now the STI cyclical sectors were all strong last year. When you look at the 5 strongest stocks of the STI, it was Yangzijiang Shipbuilding, which is a China shipbuilder, with origins back to the 1950s. That almost doubled in price by the end of the year. It actually had doubled in price throughout the course of the year, and that was the best performing STI stock last year. However, in 2016, when cyclical factors were not at work across the world, it was the least performing STI stock. So it became the best performing STI stock last year. The next 3 best performing stocks were all real estate stocks: Global Logistic Properties, UOL Group and City Developments. And then the cyclical consumer discretionary also provided us with the 5th best performing stock, which was Gunting Singapore. So there's a lot of variety in terms of the sectors and the stocks. If you look at the 5 best performing stocks last year, there was Gunting Singapore, which was also the 5th best performing stock of 2016. And then you have our SATS, which was one of the best stocks of 2016, one of the best 5 stocks of 2015. Other than that, they were all different. So over the last 3 years, as many as 13 different stocks of the 30 stock index made up the 5 best performers. So I guess the key point I'm trying to relay here is that we are a very diversified index, made up of very diversified businesses. And it's not just by the sectors, whether it's capital goods, transportation, banks and so forth. It's where the revenue is generated for these companies. We basically look at the 30 companies, look at the weightage that each of these companies have in the STI, then look at where the revenue is being reported to or geographically segmented to in the financial reports. And when you run that tally, you've actually got 46% of the revenue of the 30 STI stocks being reported to Singapore. As much as 47% is reported to Asia Pacific, with the exception of Singapore, with the exclusion of Singapore. So we're as much a Singapore benchmark as we are a benchmark relevant to regional Asia Pacific businesses. And that also adds another dimension in terms of some of our China stocks might be moving one way, some of the Southeast Asia stocks might be moving another way. So it allows more of an element of diversification for our index. Breaking it down though, looking at the STI, the best part of the STI in terms of performance last year was the banks. The 3 banks that we have as part of the STI, the OCBC, the UOB and the DBS Group Holdings. Those banks averaged around 40% gains last year, and for the first 3 quarters of 2017, net profit after tax growth was around 6%. On average, and net interest income is up to $4.8 billion, which is up from around $3.2 billion at the end of 2011. So the net interest income has grown gradually as the Fed Reserve has basically lifted interest rates. As you know, we've had the 5 interest rate hikes to date since the Fed started lifting interest rates, and another 3 interest rates expected for this year. So that would take us to 8 interest rate hikes. At the same time, our Singapore nominal effective exchange rate has been tracking the moves of the Fed Reserve, what has been transpiring in the interest rate market, And we have our meeting in April by the MAS, and at the moment the expectations are it could basically resume the gradual modest appreciation of the Singapore nominal exchange exchange rate, and that could be by 0.5% per annum if there's signs of inflation which are being led by demand pull factors. That is, if the economic bright spots are basically pulling prices up. So that's I guess the key central bank meeting for Singapore in April, thereabouts. So a lot of it again will depend on cyclical factors. Within the STI as well, we also have a new constituent. This year, Venture Corp was added to the STI, our biggest IT stock, and that now makes up 1.8% of the STI, and hence we have that information technology in the STI now, and that has happened predominantly because when you look at this chart here, you can see the cyclical sectors have very much led our broad market last year. What we have done in this chart is basically taken the full 700 stocks that we offer on SGX. We look at which sector those stocks are representing or categorised to, and then weigh the returns according to their market capitalisation. So if a stock has a $10 billion market cap, it will have 10 times the impact on the sector performance as a stock with $1 billion in market cap. And as you can see, when we take that measure, your information technology sector was very strong last year. In 2016, the semiconductor industry was the strongest of the industries. Consumer staples, particularly the agriculture plantation stocks, were the strongest of the sectors. And then coming to 2017, it was the IT sector, not just the semiconductor, but the hardware providers, the software providers, which led the market in 2017. And it was a textbook result for our market as well, because it was cyclical factors driving the economic growth. As you can see in the chart, they are all cyclical sectors. These are all the defensive sectors. So there was a lot of parallels between what we're observing on the growth front as well as what we're observing in the market front. However, towards the end of the year, the differential between the defensive sector performances and the cyclical performances basically did start to narrow because there were signs that the growth was becoming more broad-based. On average, those cyclical sectors generated around a 35% return, which was greater than the STI's 22% return. What we've done here is not look and capture every single stock that makes up the sector, but we're looking at the comparative performances of the two biggest stocks that represent each of these sectors throughout the 2017 year. And as you can see, we had very much the same story. Our two information technology stocks, the sector leaders, or the stocks that are the strongest, the biggest, the largest capitalised of the sector, they generated a 67% return. The two biggest banks were 46%. Consumer staples, Thai Beverage and Wilmar, were essentially flat after generating something like 30% returns in 2016. And then your cyclical real estate stocks were up almost 40%, and of course your cyclical consumer discretionary plays were up 25%. So this is, I guess, just an example of how sector investors may have looked at the stock market throughout the 2017 year. As we mentioned before, IT, information technology, was the strongest of the sectors. There was a global re-rating of IT stocks at the beginning of 2017. We were seeing average selling prices of electronic modules and semiconductors basically rise throughout the year, which was on the back of consumer demand. So companies were affected in both the upstream and the downstream. So upstream plays that we have, such as UMS Holdings and Micromechanics, benefited with their typically higher margins from the basic re-rating. And then your downstream plays, such as Venture Corp, which is now part of the STI, and Valuetronics also benefited. So you saw a lot of stocks basically on both ends of the upstream and downstream IT segment basically generate good gains last year. It was 107% for the sector. When you look at the 10 biggest stocks that make up the sector. They also averaged 100% gains, with the median return at around 93%. So there was a lot of consistency. It wasn't just one particular stock or two particular stocks driving the sector. There was a lot of consistency across the sector in the IT plays. These IT stocks, they average a return on equity, which is around 20%. The PE of the sector leader is Venture Corp, and that has a PE ratio a little over 20 times at the moment, which is pretty much in line with the MSCI Asia Pacific IT Index. Another important point too is we didn't just see Venture Corp rise to become part of the STI, we also have an index in Singapore known as the FTSE SG China Index. And this is about 20 of our biggest stocks which generate more than half their revenue in mainland China, or base over half their revenue, or base half their assets in mainland China. And we saw two stocks, Valuetronics and Hi-P International. Hi-P International is an Apple supplier, and that those two companies basically joined the FTSE SG China Index. So now our China Index has two IT plays, which is better than our, I guess, a comparative index would be the H-Share Index, which does not have IT plays. So there are a lot of highlights from the IT sector. I guess you could sum it up in the one line that the IT sector in Singapore, in terms of its capitalisation, grew 60%, grew 3/5 in the course of 2017 in terms of its market cap. The manufacturing sector is very important too, particularly the capital goods sector, because it's one thing looking at the sector that has performed the best. The next is to look at which sectors, I guess, didn't perform as well, which were less effective by the cyclical upturn. And we're seeing at the moment in Singapore that there's been a little bit of outperformance by the stocks that make up the manufacturing segments of the capital goods industry. So it's a little bit of a mouthful. Let me explain. Remember, we had the cyclical sectors. We had the IT sector, which was up 100%. The least performing cyclical sector was industrials. It was up 13%. Now, most of the market capitalisation, almost 4/5 of the market capitalisation of our industrial sector are capital goods stocks. And then when you look at capital goods stocks, you have transportation, you have services, but you have four core pillars that are involved in manufacturing. That is aerospace and defence, building products, electrical equipment and machinery. And those 10 stocks that we have been performing fairly well in the year to date. So there's been a little bit of catch-up, if you will, over recent weeks with the more laggard part of the cyclical sectors into 2018. But nevertheless, as you can see, these 20 biggest capital stocks also performed quite well. So in Singapore, remember we saw the electronics PMI was up quite strongly, 17 consecutive months of expansion. Broader manufacturing was also up 16 months, and that basically resonated as well into our capital goods stocks. I should also mention the Yangtze Challenge Shipbuilding. It's a pretty important stock for our market because it is the China play that's involved in shipbuilding, and it was very strong last year. And I'm not sure if you saw the statistic, but when you looked at for the numbers that we've got already, when you looked at the shipbuilding volumes that came to China in the 2017 year from January through to November, it was the orders by tonnage was actually higher than the shipbuilding order volume by tonnage in South Korea. And that was the first time in 7 years that China had more shipbuilding orders than South Korea in terms of the tonnage of the orders. So we've seen the manufacturing sector basically grow in performance. We're also seeing the manufacturing sector grow in terms of the way they are conducting their businesses. There's more emphasis on the logistics and the distribution. We're seeing traditional manufacturers move downstream so they can better face their customers, and this is basically happening in line with a lot of, I guess, the digital disruptions that are occurring in the world. It's now easier for an upstream manufacturer to face their end customers through the Internet of Things and so forth. For the active investors, there is a lot of variety in these sector performances. We showed the snapshot of the sector performances for the full year. This is a heat map which basically shows how that all transpired on a month-on-month basis. So you would expect to see the cyclical sectors at the top on a month-by-month basis, which we have, mostly IT, and then a number of the defensive sectors down here. You have materials, which was particularly strong in many instances. That was predominantly from DeLong Holdings, which is supplying hot rolled coils to China, and it can be quite volatile in share price as it has been, because the steel prices can be quite volatile as well. That has basically been a key driver of the materials sector. And then you also saw healthcare sector rise 4.7% in December, and much of that was attributed to our secondary listing of a big rubber glove manufacturing company that was mentioned in the previous presentation. Consumer sectors are also key because consumer discretionary, as we saw, was a cyclical sector that did really well last year, beat the STI benchmark, predominantly through the hotels, restaurants and leisure stocks that we have making up that segment in Singapore. Particularly Gunting Singapore, Shangri-La Asia and Mandarin Oriental were very strong stocks last year, and that led the hotel, restaurant and leisure industry much higher. And we also saw the spillover effect of the stronger real estate market help drive those stocks. But on the consumer staple business, it has been different. We have 8 stocks that are involved in agricultural production, or the plantations. There was a question in the previous presentation about the possible effect of the EU on the plantation stocks and the palm oil prices. In terms of, I'm not sure what the EU effects are, but I do know that the compound annual growth rate expected for the production of palm oil in this region is supposed to be around 7% in the 5-year period going to 2021. And there's a number of lifestyle, rising living standards, the regional use of the feedstock, of the palm oil as feedstock for biodiesel, as well as its comparative cheaper prices. That's what the analysts are looking at in Singapore in terms of potential returns. But as you know, we have the consumer staples, the key food and beverage manufacturers, processors and plantations. That makes up our consumer staples sector. It was particularly strong in 2016 and not so strong last year in 2017. So that's one of the laggards, I suppose. One of the leaders has been the discretionary size of it, the discretionary part of it. And for us in Singapore, the discretionary is quite important. When you compare how many consumer discretionary stocks, such as the services, the hotels, the restaurants, the media, the retailing, the leisure, when you compare the amount of stocks that make up that segment, it's you have 3 of those stocks for every consumer staple stock that we have that's involved in food and beverage manufacturing, processing and retailing. But nevertheless, I just wanted to reiterate the point that we are a very international exchange, and that's why we have this chart here, which just shows you how the geographically segmented revenue of the consumer staples sector. It shows that around 50% of that revenue is booked to Singapore, where a large part of it, 30 to 40%, is booked to Asia Pacific, excluding Singapore. So, that was a quick overview of the moves of these sectors. I guess the key point was that there were cyclical factors driving them, as we've mentioned. Defensive sectors were more muted, and we're seeing now at the moment, some of the least performing cyclical sectors have been, in 2017, have started on a stronger note in 2018. So I guess that objective of getting broader based growth, it is showing signs that is occurring when we take a gauge of what's been occurring in our stock market. The REIT sector that we have has been has also been fairly strong last year, as we showed in this particular side right here. It was 28%, a little bit higher than the STI's total return, which was 22%. Our REITs have an average dividend yield between 6 and 7%, which is more than twice what the dividend yield of the STI is at around 3%. We kicked off our REIT sector in 2002, so it has a 15-year track history, and the REIT sector is now around 8% of our total market capitalisation in Singapore, but it does account for 10% of the day-to-day turnover. And it's now paying up to $4 billion a year, at least, in dividend distributions to unit holders. And the REITs are very well diversified. Again, not just by their subsectors in terms of retail shopping malls, logistic and industrial parks, commercial office towers and healthcare related properties, and hospitality hotels I should mention as well, but also in terms of where these REITs are geographically located. We've started off with a Singapore focus, we've built to an Asia Pacific focus, and we now have a very strong global focus as well, with European, United States and Australian properties choosing to list through the REIT vehicles that we have in Singapore. So for active investors, there's been those opportunities, I guess, with the sector investing. There's also, and this is I guess, dollar cost averaging, which has also been important, because as we've seen, last year was a particularly strong year. It was twice the average annualised return for the last 15 years. Not every year we've seen gains. And hence, for any index, dollar cost averaging has become an important way that investors do invest. That is, take some of the timing risk out of the market. Don't commit to a certain amount of units, commit to a certain amount of money. That is, if I want to invest in an index which is trading at $1, and rather than working out how many units, I'd say I wanted to, if it was trading at $1, I'd want to trade, let's say, $1,000 worth. So I would buy $1,000 worth at the price of $1, and then next month I'm going to buy another $1,000 worth. Doesn't matter what the price is, I commit a fixed amount of money, dollar cost. I have a fixed dollar cost of $1,000 a month. Now, if the price of the index goes from $1 to $2, I'm only going to buy 500 units with my $1,000. Whereas the previous month I was buying 1,000 units at $1. And then the next month, let's say, so we're buying half as much at the high prices, and let's say next month the index was at 50 cents. If the index was at 50 cents, I could buy 2,000 units of the index. And that's how dollar cost averaging works. You basically commit the fixed amount of money to your investment. If the price is lower, you buy a lot more. If the price is higher, you buy a lot less. So for investors that were dollar cost averaging on the STI, they averaged around 7% per annum since the beginning of 2013, and did as much as basically buying 1/3 less or 1/3 more at the highs during that period, or 1/3 less at the highs during that period than they did at the lows of the period. So that has been that's been emerging in Singapore as a common trend for the more passive investors that don't wish to take that wish to mitigate against some of the timing risks. And that trading, I guess, methodology does apply pretty much across the world as well. You might be able to apply that to exchange-traded funds. In Singapore, we have multiple exchange-traded funds that follow a number of indices across the globe, as well as in Singapore. And where we've seen a lot of growth in this product is in the sector-related ETFs, particularly in real estate investment trusts, which again is one of our strengths in Singapore. With the real estate investment trusts ETF, you're allowing investors to basically invest in a whole basket of ETFs, and basically that basket is a passive investment that will enable the investor to access the dividend yields and the changes in price of the constituents that make up the index over a period of time. So that's suiting the passive investors, and over the last 12 months or so, we've seen the launch of 3 ETFs that track the REITs and the last one to launch has been particularly tracking the Singapore REIT index as well. So the Singapore REITs, I should also just mention, they average a leverage ratio of around 35% for the full 30 to 40 real estate investment trusts and staple trusts, and that's below the leverage limit, which is around 45%, thereabouts. The structured warrants have been for more active investors, those active investors that might be used to the sector trading or the more shorter term timeframes, and these have enabled investors to have access to big indices across the region, such as the Hang Seng Index and the H-Share Index, and enable investors to have that leverage exposure and apply that leverage exposure to their portfolios as well, because these can be used as hedging tools, just as daily leverage certificates can as well. This is the most recent product to launch in Singapore. We have the daily leverage certificates available on the indices, the MSCI Singapore, which is highly correlated, very similar to the Straits Times Index, as well as the Hang Seng Index and the H-Share Index. And basically, their daily leverage certificates, what this means is that an investor might take a short view on the market, and they might take take a short position on the DLC for the next 3 days, and if it was a 5 times DLC contract, they would be selling the DLC day 1. Let's say by the end of day 3, the index has fallen 3%. So the anticipation was correct, the market was going to fall. The investor took a short position with a 5 times DLC on the index, and then if the index had fallen 3%, the investor would have made 15%. Conversely, if the index had moved up 3% and the investor had the exposure, then the investor would have lost 15% if he could have lost 15% had the market moved against their anticipations. So you can see how the leverage factor works, and it's for investors obviously with that leverage factor that might have a position already in the markets, or for the investors that are more sophisticated and understand the logic and the risks of such products. So there are some pretty exciting products. We've got them on the active side, we've got them on the passive side. We obviously have lots of interesting times ahead of us as well. The key challenge for the world, I guess, as it is just for Singapore, is to sustain a lot of the economic growth and momentum that we've seen already occur in 2017. And that's a key goal across the world. We have a lot of regional strengths that we can draw on across the region, particularly in Southeast Asia, which is seeing its bilateral trade grow again with China, where it did die off a little bit a few years back. It's getting to be stronger again. There are key drivers, innovative drivers in our region. We are becoming a lot more digital focused. Did you know that our internet economy is expected to grow from 2% to 6% by 2025? That's a 27% compound annual growth rate. And we in Southeast Asia spend on average 140 minutes a day on e-commerce platforms, which is much greater than in the US, which is 80 minutes a day. So there's going to be a lot of potential reach for a lot of our businesses through the region, with a lot of people coming online every day for the first time on the internet through the online retailing and so forth. We have also a number of stocks, of course, that are very highly related to the region. We're not just, obviously, as we said before, we're not just a Singapore-centric exchange. We have a number of Southeast Asian listed companies on the market. We also have quite a few China-related enterprises as well. And we have the pretty big, exciting global structural reform of the Silk Road Economic Belt and the Maritime Silk Road coming together to form the Belt Road Initiative. We start from Xi'an here, we go through Tajikistan, go up to Moscow, to Rotterdam, and this economic belt, which ends at Venice, is going to match up with the Maritime Silk Road, which comes from Fuzhou down to Southeast Asia, up to Colombo, Kolkata, Kenya, and up and goes through Athens and meets up in Venice. This whole big pipeline the infrastructure development associated with this is pretty incredible. It's going to basically improve trade flows and financial flows across 50 companies. It's the biggest mega economic initiative the world has seen, and we're seeing a lot of activity in terms of Chinese banks in Singapore committing funds to Singaporean companies that are getting more involved in the BRI projects. And one of my favourite jobs at SGX is to run through financial statements every quarter and run through and look at how companies are aligning themselves with the BRI initiatives, particularly those China-based enterprises that are looking to make acquisitions in our part of the world to help facilitate trade, to help facilitate financial flows, which we're looking to see those trade flows increased to $2 trillion by 2020, which is only 2 years away. So that's growing. Based on the current trade flows, that would be growing by around 40% from when that projection was made last year. So there's obviously a great deal of opportunity ahead of us, where obviously the US economy is a key point, as the previous speakers noted, but again, timing is everything, as I saw what Derek Tan put up with that Yoda slide. I would like to draw your attention to our resources, because at the exchange we do have our resources that are freely available. A lot of what I do every day is actually writing. I write a SGX My Gateway Report, which I do believe we have some subscribers here. And that SGX My Gateway Report basically sums up a lot of the highlights of the previous week in Singapore. And that report, you can subscribe to it. There's the market updates, which make up the bulk of the report, are available on our website, sgx.com research. And importantly too, we have a platform known as Stock Facts. So it's sgx.com Stock Facts. And in that, you're able to basically scan and screen all those stocks that make up the sectors. So if you wanted to look at the 32 real estate investment trusts, or you wanted to look at the IT stocks, you're able to do that through this platform and sort them all according to market capitalisation and so forth, which is a key resource for us as well. So there's a number of a number of items of content support. We're also love doing these presentations. We really love coming to Malaysia. So please do ask Kananga to invite us back. And I'll finish on that note. Thank you so much.
Thank you, Geoff, for the very informative sharing. So again, due to time constraint, we would like to open up the Q&A. 2 questions from the floor. Anyone interested? Please raise up your hands. We will hand over the mic to you. Anyone? 2 questions. Any question for Mr. Geoff? No. Sorry? Yeah.
Hello, good morning. Thank you, Mr. Geoff, for the insights into Singapore market. So this is one question regarding REITs. I'm one investor for REITs in Singapore too. But of course, due to the recent hike in December 2017 in Singapore, I believe the price has been set to the REITs market. What would be your opinion towards the REITs market in the first half of this year for Singapore?
That's a really good question, and the question is, there's interest rate hike potential. We're in an interest rate hiking environment in the US, and how does that transpose to our real estate investment market? We've got a lot of recent history here too, because 2015, a lot of markets, at the end of 2015, there was a big scare in the market that the US was going to hike rates too quickly. When the US started hiking rates, they were giving quite a bit of forward guidance that was showing that it's going to be quite aggressive in interest rate hikes. As a result of that, the REIT market in Singapore was sold off very strongly. It actually fell, and it was a big underperformer. But then those interest rate hikes did not eventuate, and the REIT market recovered to become an outperformer in the following year, in 2016. So they are very interest rate sensitive. But there's been there's two key legacies that the Fed Chair, Janet Yellen, is leaving behind. The first one is forward guidance on interest rate changes. They've learnt their lesson. They don't scare the market so much with a hawkish tone unless they really have to. The second, of course, is the quantitative easing long-term asset purchases. But you can't take away from the fact that the forward guidance on US interest rates has become a key measure to help stabilise the asset prices, especially real estate and real estate investment trust sentiment, based on what they have been saying, and hence continuation has been a key factor of that. But in Singapore, in terms of interest rate hikes, interesting to note that about if you take, let's say, 25 of the biggest real estate investment trusts, around 3/4 of their interest rate exposure is hedged. And also, short-term rates are going up, but remember, long-term rates are really low. The yield curve in the US at 70 basis points, it's like at a 10-year low, because there's so much negative yielding debt in the world, and there's not too much inflation. So at the moment, I guess the inflationary backdrop and the central bank policy is not a huge threat, but no, that can change. It's if you have demand pull factors that basically pull inflation up, which are currently pulling growth up, then that might change. That view on the market could change. But at the moment, as the interest rate hikes have been growth induced, you think of it this way: you have higher interest rates because you have more economic growth, and the most cyclical of your REIT sector, the commercial office towers, if there's more growth, particularly in Singapore, where you have a lot of big international banks having office space, if the growth's good, the banks come and they want more space, and hence the commercial rental returns are actually pretty good because it's on the back of growth, which is also going up with the resumption or normalisation of interest rate policy. But it's when the inflation, if the inflation does get out of control, that would be seen as a negative to what we've got in the REIT market. And we'll know in April, as we said, the effective exchange rate in Singapore. If we look at what the MAS is saying, if they resume a gradual modest appreciation of 0.5% per annum, look at the writing, and if it's demand pull, if it's all demand pull, then that might be seen as not such a bad thing. But if it's cost push, then it's not such a good thing. So it's almost as simplified and binary as that.
Any one last question for Geoff? Okay, if no, please give a round of applause to Geoff. Thank you.